Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back. Little different setting today. Welcome to my couch. Today I'm going to be answering some of your questions from Instagram. So if you've come across from Instagram because of this Q&A, please drop me a like and subscribe. If you don't follow me on Instagram and you've just followed me on YouTube, jump over to Instagram. It's also under Investing with Tom, and that's where I'm likely to run any of these sort of Q&A questions from in the future. But if you do have any other questions, drop them in the comments below on YouTube and I'll try and get to those ones in the next video as well. But for now, let's get into it. Alright, so I've got actually quite a few questions on here from Instagram, so I'm going to race through these really quickly. If there's any of these questions that you'd like me to go into a lot of detail with and make kind of a full video about, feel free to let me know, but I'm just going to get into things now. So first question from Summit Dodaja. I hope I'm not butchering some of these names. He asks, what are the best investing books? So I've got three main investing books that I would recommend as a starting point. Those would be in no particular order, or the first two in no particular order at least, would be One Up on Wall Street by Peter Lynch, and also Rule 1, and actually also probably Rule 1 and Payback Time, both by Phil Town. Those are really good sort of intro level books to get your sort of mindset and the right frame of mind for investing in the stock market. And then also Phil especially has some really good tips around valuation of companies as well. So that's a good starting point. And the third one would be the tried and true Intelligent Investor by Ben Graham. If you don't know who Ben Graham is, he's basically the professor that taught Warren Buffett a lot of what he knows about investing in the early days. I actually read that book first out of those three, and to be honest, it's pretty heavy. It was written in the 40s and it's written by, a professor in finance. So it is pretty heavy. I would recommend in hindsight, probably reading Peter Lynch and Phil Town first, just to get your head in the right space, especially if you don't have a finance background. So those are my top three books. Next question. So Tough Life Motivation on Instagram asks how to get started. It's a pretty broad question, but I would say the best place to get started with investing is just educating yourself. So reading books where possible, following people on YouTube that talk about investing, just to get you up to speed with some sort of basic knowledge. In terms of your first investments, I really like ETFs as a starting point. So looking at tracking some sort of market index, especially. From there, once you learn more, you can get into looking at individual companies. So that's a good starting point. What else have we got here? So Milling About Money asks, any tips for beginners to investing? See previous question. Digital Hustles asks, what assets do you own? That's a personal question, but very quickly to run through. So basically at the moment, I'm about a 50-50 split, outside of my car and all that kind of stuff. I'm about a 50-50 split between shares in publicly traded businesses and cash. I don't currently own a house. I'm renting at the moment, but those are kind of the two places where most of my assets are split at the moment. I'd like to get that cash position lower and the equity position higher, but companies are at very high valuations at the moment. So as it stands at the moment, the equity portion is not really growing in terms of the number of shares or money that I'm putting into that account. The cash position is growing. Hopefully I can sort of change that in the coming months, but that's kind of where I'm at the moment. Next question, Gabrielle Wolf asks, what podcast would you recommend? I've actually made a video on this in the past, so if you head back onto the Investing with Tom YouTube channel, I've got a video called Top 3 Podcasts, but just to save you some time clicking into there, very quickly, my top three, number 3 is the Investors podcast, We Study Billionaires, with Preston Pish and Stig Brodersen. Number 2 would be the Young Investors podcast with Hamish Hodder and Brandon from the Aussie Wealth Creation YouTube channel. And number 1 would be Invested by Phil and Danny Town. Love all three of those podcasts. And that's the questions from Instagram. So a couple of questions from YouTube. I got a question around the raise website or app. I hope I'm pronouncing that correctly. R-A-I-Z, Raiz. Essentially, I actually hadn't heard of this app, to be honest, until the last couple of days, but I did a bit of research on it before. Essentially what it does is you link up your credit card or your FPOS card with the app, and essentially it rounds up any purchases that you make. So let's say you go out and buy a coffee for $3.50 rather than making a coffee at home for whatever reason. Basically it rounds that purchase up to $4 and it takes that extra 50 cents and puts it into an investment account. So I guess my perspective on this, anything that can get people into investing in the first place is a great thing in my books. And this is a pretty cool tool to get kind of people started. But in saying that, it does sort of contradict, I guess, a couple of the approaches that I tend to take. So my approach to investing is I spend what I've got left after saving, not save what I've got left after spending. So I'm sure you've heard it a million times before, but I'm a big fan of paying yourself first. So as soon as you get paid each week or fortnight or whenever it is, assuming you work a regular job, essentially I put quite a large percentage of that, as much as I can handle really, into investment accounts. And after that, I've got enough money to go about my daily life, pay my expenses, and then maybe have a little bit left over for spending money where I want. So that's sort of my approach. The raise approach seems to be sort of the other way around. So it almost incentivizes spending, which I don't think is a good thing. And in terms of the investments that are actually available, I'm just having a quick look on there. Essentially, it seems like you can just pick, and correct me if I'm wrong here if anyone has used Raise, but it seems like you can basically just pick portfolio types. So you can be sort of conservative, aggressive, and anywhere sort of in between. And it basically determines how much is invested in money market accounts and then bonds and then the stock market. It's kind of a sliding scale like that. And that really doesn't fit my investing strategy either. So I want full control over the companies that my money goes towards. I want to make sure I'm buying companies that I understand and that I care about, have great moat, have a good management team, and I can pick up at a fair price that offers me a margin of safety. So if I am using Raise and it's just investing in a general kind of market, even in that most aggressive fund, it just doesn't fit my investing strategy. So it's probably not an option for me. But hey, if it works for you and it lets you save a bit more money that you wouldn't otherwise save, go for it. I think that's fantastic. So good starting point. Okay, so one bonus question here from precision_cuts12 on Instagram. They ask, what is the best way to generate wealth out of real estate versus the stock market? So this is a big question. The short answer is that assuming you're not using any debt, which again may vary a lot between these two situations, assuming you're not using debt, the stock market has outperformed massively over the last century or so. In the States, you're probably looking at about an 8 or 9% return over the last century. In New Zealand, it's probably about 10%, and in Australia, I think it's right around that 9% mark as well. So across the board, you're looking at about a 9% compounded rate of return. That includes both capital appreciation and dividends, and then reinvesting those dividends to have that sort of compound away. Real estate has largely gone up at the rate of inflation, maybe slightly above, over the very long term, over the last century. Pretty much around the world, real estate prices have gone up a lot quicker than that over recent years. And I'm not an investor in real estate, so I'm going to be biased on this. But what I will say is that real estate does have a couple of really, really big advantages over the stock market that I don't have as a stock market investor. Well, I do have one of them, but I choose not to use it for very good reasons. The first one is leverage. So with real estate and income producing real estate like rental properties, it's very common and relatively straightforward to use a high percentage of debt. And it makes a lot of sense and can juice up your return on equity in a lot of situations. So if you are able to use debt strategically, be smart about it, and it can massively inflate your return on equity and grow your net worth over time actually a lot quicker than the stock market probably can. So if you're able to pick up a rental property that's able to pay the mortgage, pay for any repairs, pay for rates or property taxes, all that kind of stuff, and still generate a positive cash flow, even with interest rates maybe changing a little bit, that'd be one to watch out for. That can actually generate some pretty massive returns. And then you also have the opportunity to refinance houses and put that into additional properties, and you can try and continue to snowball that investment. So if you're going down that route with property, there's obviously a little bit more risk because you've got some debt. So if property crashes, or you need to get out short term for whatever reason, you need to sell that investment, it's not as liquid as stocks, but you can definitely make some very high returns in real estate investments. The other advantage with real estate is that you can depreciate your house, especially in the US. I'm actually not too sure if the rules here in New Zealand, but I know that in the States you can depreciate your house over, I think it's a period of 25 years. So if you make let's say you make a $10,000 profit on your rental property for the year, you can then depreciate sort of 1/25 of the house every year as well, and take that off that $10,000 profit. So you're essentially making your profit look a lot smaller than it is in sort of cash terms for that year, and you can actually get taxed on a smaller amount. So that's a really big advantage in terms of taxation with real estate. But long story short, I prefer the stock market. It's really good if you're working with smaller amounts of money to get started, and if you want to be a little bit more liquid, and if you want a larger range of companies to work with and you don't want to deal with rental properties and the hassle of tenants and taking out debt and all that kind of stuff, the stock market is definitely a great option too. So that was a bonus question. Hope you enjoyed that as well. As I say, if you did, drop me a like, hit subscribe, and leave any questions below for the next one if you are interested in me running another one of these videos in the future. But for now, have a great day, and I'll see you in the next one. Cheers.